Welcome to The Deep Dive, the show that cuts through the noise to get you truly well informed on the topics that shape our world. Today, we're plunging headfirst into the incredible complexity of the global financial system. That vast, interconnected web that quietly shapes everything from, say, your mortgage rate to the stability of the entire economy. And at its heart, there's this seemingly abstract set of rules known as Basel III. The 2008 global financial crisis was a pivotal, almost catastrophic moment that exposed the deepest cracks in that system, and while it directly necessitated this deep dive. Our mission today is to truly unpack Basel III, the international regulatory framework developed by the Basel Committee on Banking Supervision, or BCBS. We'll explore how this framework was designed to, fortify the global banking sector, what specific crucial changes it brought, and its ongoing impact and challenges, especially as we approach what some are calling the end game here in the US. Consider this your shortcut to truly understanding the mechanisms behind financial stability, gaining crucial insights into how regulators are trying to prevent the next big crisis, and, well, where the current tensions and debates actually lie. So, let's start at the very beginning with the genesis of Basel III. This isn't just some dusty financial textbook. It's the third major iteration of international banking rules, directly born from the ashes of the 2008 global financial crisis. That crisis, as you remember, laid bare severe deficiencies in the system: inadequate capital, a severe lack of liquidity, rampant excessive risk-taking, and an intricate, almost invisible interconnectedness that caused widespread bank failures and triggered profound economic distress.
Right. And what's fascinating here is that this is a recurring pattern we see throughout financial history. Significant regulatory reforms almost always emerge as direct responses to major financial upheavals, explicitly designed to fix past failures. This raises an important question for all of us. Can these rules truly be forward-looking enough, or do they inadvertently shift risk elsewhere in the financial system, kind of creating new vulnerabilities down the line?
That's a critical point to keep in mind throughout our discussion. So, if the GFC was the wake-up call, what exactly were the core objectives of this new framework? What was Basel III ultimately, trying to achieve?
Well, it was a profound shift, really. The overarching mandate was to significantly enhance the banking sector's capacity to absorb financial and economic shocks. The idea was to build a tougher, thicker financial shield for banks, ensuring that even under severe stress, credit could continue to flow to the real economy. It also aimed to elevate overall risk management practices within banks.
Okay, so not just patching up holes, but a complete rebuild of the foundation. What were the specific blueprints they laid out?
Exactly. The key specific objectives were to strengthen capital standards, not just more capital, but crucially, higher quality capital.
Yeah.
It also aimed to dramatically improve risk management across the board, enhance liquidity, reduce systemic risk posed by those too big to fail institutions, and boost transparency through mandatory public disclosures.
Right.
This was a fundamental shift from a kind of siloed approach where each bank was seen in isolation to a comprehensive, holistic view of financial stability. It recognized that preventing individual bank failures just isn't enough. The whole system needs safeguarding.
I see.
This shift meant banks had to develop far more sophisticated internal systems, which certainly increased compliance costs, no doubt, but ultimately it made them much more resilient.
And this wasn't an overnight revolution, was it? It was an evolution. Basel Hull back in '88 was pretty basic, really just focused on credit risk. Then Basel II in 2004 introduced more risk-sensitive requirements and the three pillars concept. But Basel III truly tightened things up, directly addressing the shortcomings of 2008 with a laser focus on capital quality, introducing a non-risk-based leverage ratio, and comprehensive liquidity requirements. It's clearly a continuous, iterative process, constantly adapting.
Absolutely.
Now let's open up the blueprint and examine those foundational pillars that build this robust framework, starting with Pillar 1, minimum capital requirements. Think of this as the financial firewall, the absolute bedrock that reinforces bank regulation by mandating not just higher levels of capital, but fundamentally improving its quality.
Indeed. Basel III really honed in on what kind of capital counts most when absorbing losses. For Common Equity Tier 1, or CET1, which is the highest quality capital like common shares and retained earnings, the minimum requirement is 4.5% of a bank's risk-weighted assets, or RWAs.
Okay.
Then there's Tier 1 capital, which includes CET1 plus additional Tier 1, needing to be at least 6%. And finally, total capital, which adds Tier 2, must be 8%. A key move here was the elimination of Tier 3 capital, emphasizing that focus on only the highest quality, most loss-absorbing capital.
So RWAs are crucial, right? They're a bank's risk exposure metric, directly influencing how much capital they must hold. But what I found particularly compelling in the research about Pillar 1 was this idea of the output floor. Could you explain what makes it so groundbreaking?
Ah, the output floor. Yes, it's a significant innovation. It's basically a mechanism ensuring that capital requirements determined by a bank's incredibly complex internal models can't fall below a predetermined percentage of what a simpler, standardized approach would require.
Right.
And this isn't a one-and-done shift. It's a gradual tightening, starting at 50% of the standardized requirement in 2025 and steadily increasing to 72.5% by 2030.
So, the very banks who invested fortunes in hyper-sophisticated internal models trying to optimize capital down to the last dollar are now effectively told by regulators.
Thanks for playing, but we're putting a hard limit on how low you can go.
Pretty much, yes. It's designed to curb what regulators saw as overly optimistic assumptions in banks' internal models and to reduce variability in RWA calculations, prioritizing comparability and consistency across the board. For you, the listener, this means banks that heavily relied on their own models might now find themselves needing to hold more capital than they anticipated.
And beyond just broad capital requirements, Basel III also brought enhanced risk coverage. It promotes more integrated management of market, counterparty credit, and operational risks. One interesting detail here is the incentive to move over-the-counter, or OTC, derivatives to central counterparties, known as CCPs.
No.
These CCPs benefit from a significantly lower 2% risk weight for trade exposure, compared to much higher charges for bilateral dealer trades. This pushes complex, often opaque derivatives into more transparent, centrally cleared environments.
And as we'll discuss later with the U.S. endgame proposals, we're seeing an even further shift towards standardized models for operational risk, moving away from banks using their own internal models for those calculations.
Yes, that's a key point in the U.S. proposal.
If we connect this to the bigger picture, the strong emphasis on the quality of capital, particularly CET1, reflects a critical lesson learned from past crises. Not all capital is equally effective in absorbing losses.
Absolutely crucial.
While this undeniably enhances stability, this higher quality capital is generally more expensive for banks to hold, which directly impacts their profitability.
That's the trade-off, isn't it? Stability versus cost.
While Pillar 1 gives us the crucial capital numbers, the regulators knew that rules on paper are only as good as the oversight. That brings us to Pillar 2, the supervisory review process, which is essentially the ongoing quality control. This pillar focuses heavily on the qualitative aspects, mandating that banks have robust internal processes to assess their own capital adequacy and requiring rigorous supervisory review of those assessments.
Precisely. Pillar 2 delves into key areas like firm-wide governance, comprehensive risk management oversight, including, off-balance sheet and securitization activities, sound compensation practices, and regular stress testing. It also addresses crucial areas like interest rate risk in the banking book, or IRRBB.
Okay.
This pillar acknowledges that, rules alone are insufficient. For you, the listener, it's about the deep dive into how banks manage risk, not just how much capital they have. Effective oversight, strong internal controls, and a sound risk culture are equally vital for true resilience. It allows for a more nuanced and adaptive regulatory approach, moving beyond just numerical compliance.
And finally, Pillar 3. Market discipline, which is the transparency tool. This pillar requires mandatory public disclosures of specific qualitative and quantitative information, like solvency, leverage, and liquidity ratios.
Right, putting it all out there.
What I found particularly compelling about Pillar 3 is that this isn't just about ticking boxes for regulators. It's a deliberate strategy to leverage market forces for bank discipline. By making a bank's risk profile and capital adequacy transparent, investors and analysts are empowered to make more informed decisions.
That's a crucial point. This transparency is intended to incentivize banks to maintain sound practices beyond just meeting minimums. If a bank looks shaky on paper, the market should react, ideally before a crisis hits. However, it also places a significant operational burden on banks to ensure utmost accuracy and consistency in their public reporting. Any inaccuracies or inconsistencies can quickly erode market confidence and potentially trigger supervisory intervention. It's a double-edged sword in some ways.
Beyond those three foundational pillars, Basel III also introduced several key regulatory components and buffers designed to further strengthen the system. First up is the leverage ratio, serving as a non-risk-based backstop.
Yes, the simple backstop.
Its purpose is to directly constrain excessive leverage, which was a critical lesson from 2008 when some seemingly well-capitalized banks still failed due to simply taking on too much debt.
The leverage ratio is elegantly simple, actually. It's calculated as Tier 1 capital divided by the exposure measure, which includes a bank's total consolidated assets, regardless of their specific riskiness.
Regardless of risk. Okay.
The minimum requirement is a binding 3% across the board. For systemically important financial institutions or SIFIs in the U.S., the Federal Reserve Bank set a higher leverage ratio of 6%. Now, this raises an important question. While its simplicity is a strength, could it inadvertently incentivize banks to hold riskier assets that have low-risk weights as long as they stay within the leverage ratio?
Ah, gaming the system potentially.
Potentially. But empirical studies, however, suggest that the increased stability provided by the leverage ratio generally outweighs this potential risk. It seems to work overall.
Then we have the crucial liquidity standards, ensuring both short-term and long-term stability. The first is the liquidity coverage ratio, or LCR, designed for short-term resilience.
Right. The LCR ensures banks have enough high-quality liquid assets, or HQLA, things like government bonds and cash, to cover 30 days of stress cash outflows.
30 days, okay.
This standard was phased in and reached its full 100% effect in 2019. Complementing this is the Net Stable Funding Ratio, or NSFR, which promotes long-term structural resilience. It ensures stable funding over a one-year period, specifically discouraging over-reliance on risky short-term wholesale funding. This became operational in January 2018.
Think of it like this. A bank is essentially borrowing money from you for a few months, your checking account, and then lending it out for decades, like a mortgage. That's a massive mismatch.
A huge mismatch. Classic banking.
Basel III says, we need to make sure you have enough wiggle room, enough liquid assets, so you don't collapse if everyone suddenly wants their short-term money back.
Mm-hmm.
These ratios directly address what's called maturity transformation, where banks borrow short-term and lend long-term, which is fundamental to banking, but carries inherent liquidity risks.
And their impact extends far beyond individual banks into the broader markets. The LCR's bias towards government bonds, for instance, can reshape demand in those bond markets.
Interesting.
Maintaining these buffers incurs costs for banks, such as lower returns on HQLA and higher long-term funding expenses, which directly impacts their profitability. This highlights a fundamental trade-off: the push for enhanced financial stability versus supporting robust economic growth.
Right, that tension again.
Banks might respond by reducing loan volumes or raising lending spreads, affecting the flow of credit to businesses.
Beyond specific ratios, Basel III introduced capital buffers, which are truly macroprudential tools designed for systemic resilience to protect the entire financial system.
Yes, thinking bigger picture.
First, the Capital Conservation Buffer, or CCB, a mandatory 2.5% CET1 buffer, effectively raising the true minimum total CET1 to 7%. If a bank's capital falls within this buffer range, it restricts discretionary distributions like dividends and bonuses to ensure capital is retained.
Then there's the Countercyclical Capital Buffer, or CCIB, a dynamic 0.2% Tier 1 buffer. Regulators can actually require this during periods of excessive credit growth, like during a booming economy, to absorb losses during an inevitable downturn.
So they can turn it up.
Exactly. And critically, they can release it during stress to support lending, allowing for flexibility based on national economic conditions. It's meant to lean against the wind.
And for those too big to fail institutions, there's the Global Systemically Important Bank, or GSIB, surcharge, a 3.5% RWA surcharge. This compels GSIBs to internalize some of the systemic risk they pose. However, it can increase their capital costs and, some argue, potentially act as a disincentive for banks to expand to GSIB status.
That's the debate, yeah. There's also a similar framework for domestic systemically important banks, or DSIBs. Okay, the key takeaway here is that these buffers represent a profound shift towards a macroprudential approach. Instead of just protecting individual banks, they're designed to protect the entire financial system from systemic risks, particularly those arising from excessive credit growth or concentrated risk in large interconnected institutions. It introduces a dynamic element to capital requirements, allowing them to flex based on the economic cycle.
Now let's talk about the reality check, global implementation, and the formidable challenges faced. Despite the BCBS's target of January 1, 2023 for the finalized Basel III reforms, we've seen significant variation in implementation timelines across major jurisdictions.
That's right. It's been quite fragmented. For example, both the EU and UK anticipate implementation to commence on January 1, 2025. The US, with its Basel III Endgame proposal, was published in July 2023, with the final rule publication anticipated in, well, Q2, Q3 2024.
Still waiting on that one.
Still waiting. Canada has even indefinitely postponed increases to its Basel III capital floor due to economic uncertainty. This disparate implementation creates an uneven competitive landscape for banks and raises significant concerns about regulatory arbitrage, where financial activities might shift to less stringent jurisdictions.
Right, the risk just moves elsewhere.
Exactly. This, frankly, risks undermining international financial stability.
And it's not just varied timelines, it's also about extended phase-in arrangements, making it feel like a never-ending endgame.
Yeah, the end game keeps getting extended.
Many components, like capital ratios, LCR, and NSFR, had phase-in periods stretching years, some into the late 2010s, with the output floor only starting in 2025 and going all the way until 2030.
It was a very long tail.
The repeated delays and extended phase-ins, particularly the very term endgame, really highlight that financial regulation is a dynamic, iterative process, not a static endpoint. It's an ongoing conversation, not a final decree. This creates continuous uncertainty and necessitates ongoing investment for banks.
Absolutely. And that brings us to the specifics and contentions of the U.S. Basel III Endgame. This proposal, released in July 2023, primarily targets banks with over $100 billion in total consolidated assets. That's about 37 large banks, collectively holding over three-quarters of all bank assets in the U.S.
Wow, so the big players.
The big players. Smaller community and regional banks would generally not be subject to these specific, more stringent rules.
And the proposed changes are quite significant. An estimated average increase of approximately 16% in CET1 for large banks, rising to a hefty 21% for GSIBs.
It's a big jump.
It also involves replacing internal models for credit and operational risk with new, risk-sensitive, standardized approaches. A truly crucial change is the removal of the AOCI opt-out for Category 3 and 4 banks.
Ah, yes, the AOCI change. Very controversial.
This means unrealized gains and losses on available-for-sale securities will now directly impact their capital, phased in over 3 years from July 2025. Plus, increased GSIB surcharges could add an estimated $13 billion in risk-based capital across GSIBs.
These specific elements, like the AOCI opt-out removal, represent divergences from the BCBS's finalized framework. This phenomenon is sometimes called gold plating, where a jurisdiction goes above and beyond the international standard.
Gold plating. Okay.
And it's been a significant point of contention for the U.S. banking industry. For U.S. banks, this often means higher capital costs than their international counterparts, potentially putting them at a competitive disadvantage globally. That's why it's such a lightning rod for the industry. The debate over including U.S. Treasury securities in the supplementary liquidity ratio calculation further illustrates how specific regulatory design choices can have broad and sometimes unintended impacts on financial markets.
So what does this all mean for banks' profitability and lending? Higher capital and liquidity requirements generally mean banks have to hold a greater proportion of their assets in reserve rather than deploying them in higher-yielding activities. This can directly impact profitability.
That's the immediate thought, yes.
While initial predictions often pointed to a negative correlation, some analyses suggest a more nuanced outcome. Better capitalized banks may be perceived as safer, which could attract more investors in the long term, as was seen with South African banks, for instance.
Right, there's a potential long-term benefit to being seen as rock solid. However, there's also the potential for reduced loan volumes and wider lending spreads, particularly affecting businesses without strong credit ratings. This highlights that fundamental tension again, the push for financial stability versus supporting economic growth. While banks become safer, their capacity and willingness to extend credit might diminish, potentially affecting the broader real economy.
This tension also plays out in the economic growth debate. Initial critics, like the OECD in 2011, estimated that Basel III could reduce annual GDP growth by, 0.05 to 0.15 percentage points, a drag on growth.
That was the initial fear, yeah.
So what does this all truly mean for the economy? More comprehensive analyses actually suggest a positive long-run effect on GDP, potentially between 0.6% and 1.6%, primarily by mitigating the severity and probability of financial crises.
This is a key insight to grasp. The immediate, tangible costs of regulation are often more visible than the diffuse, long-term benefits of crisis prevention.
It's hard to quantify a crisis that didn't happen.
Exactly. It's like buying expensive car insurance. You pay every month, you hope you never use it, and you might grumble about the cost. But if you get into an accident, that diffuse long-term benefit of having stability suddenly becomes very tangible and incredibly valuable. Basel III is, in a sense, that insurance policy for the financial system.
Good analogy.
A stable financial system is an indispensable prerequisite for sustained economic growth. You can't really have one without the other, long term.
However, there are also unintended consequences, particularly regarding the flow of risk. Basel III has inadvertently contributed to increased risk-taking by borrowers, some studies suggest. Facing higher loan costs, borrowers have engaged in riskier investments, leading to higher volatility and likelihood of default.
So the risk shifts,
This means risk can shift from regulated banks to the broader economy.
and then there's regulatory arbitrage, as we touched on. If traditional banking services become uneconomic due to overcapitalization, activity can migrate outside the traditional regulatory perimeter into the less regulated non-bank financial sector, or NBFIs, shadow banking.
Shadow banking.
This can inadvertently keep system-wide leverage high and create new complex bank NBFI linkages. Think of risk migration as like water flowing to the path of least resistance.
Always finds a way.
It implies that effective financial regulation needs to be comprehensive across the entire financial ecosystem, requiring continuous monitoring of the broader system for emerging risks, not just those within banks.
These rules also present unique challenges for smaller banks. The U.S. endgame largely exempts them, but this can create a perception of secure large banks versus insecure smaller ones, potentially accelerating deposit movement during instability.
That's a real concern, especially after the events of 2023. Indeed, smaller non-G-SIBs have their own vulnerabilities, including unrecognized losses on securities from interest rate hikes and a growing reliance on uninsured deposits. We saw that tragically demonstrated by the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank in 2023.
Right.
They also often have high exposure to commercial real estate loan losses, which is another area of concern right now. This raises important questions about whether less stringent rules for smaller banks create new systemic vulnerabilities if risks accumulate in this less regulated segment.
All these factors contribute to the ongoing global regulatory fragmentation and inconsistency. The varied and delayed implementation across jurisdictions undermines the goal of a consistent global framework, creating an unlevel playing field and incentivizing arbitrage.
It really does.
The U.S. gold plating exemplifies this, further adding to the complexity, potentially putting some national banking systems at a disadvantage.
It makes global coordination much harder.
So, looking back, Basel III was a monumental effort to fortify the global banking system in the wake of the 2008 financial crisis. Its comprehensive reforms, including, and the Basel Committee on Banking Supervision is constantly adapting, pushing the boundaries of what financial regulation can achieve. They're working on strengthening supervisory effectiveness, addressing emerging risks like those from third-party vendors, and even beginning to grapple with climate-related financial risks.
Climate risk is a big one now.
This is a continuous process of learning and adapting, where every crisis or new challenge refines the next layer of protection.
That's right. Financial regulation is a perpetual process of adaptation, a continuous arms race against evolving risks. The fundamental trade-off between fostering financial stability and ensuring robust economic growth will remain a central consideration for policymakers globally. There's no easy answer.
So as you reflect on this massive ongoing effort to secure the global financial system, how do you think societies can best navigate this delicate balance to ensure a resilient yet dynamic financial system for the